everyone. It's a privilege to share with you the journey of banking, a system that has touched every aspect of human progress. From its humble beginning in ancient societies to sophisticated financial networks, we rely today banking has been a key enabler of economic growth and innovation. In this session, we'll delve deeply into its origins, classification, systems, and its pivotal role in our economy. Let's begin. The roots of banking go back thousands of years. Early banking systems emerged as civilizations advanced. Merchants and goldsmiths offered safekeeping services, loans, and currency exchanges. For example, in ancient Babylon, temples doubled as banks, safeguarding wealth and facilitating loans. This illustrates that trust has always been a cornerstone of banking. At its core, banking is about managing money, accepting deposits, providing loans, and facilitating payments through organized institutions. Over time, it evolved to include investment, advisory, and risk management services, becoming integral to the global economy. Early forms of banking. In ancient Mesopotamia and Egypt, early banking revolved around trade. Farmers and traders deposited surplus grains or metals, receiving receipts as proof. These receipts became a form of currency, simplifying transactions. In Greece and Rome, moneylenders offered loans to support trade and wars, often charging interest. This practice laid the groundwork for modern banking systems. Even then, the focus was on enabling commerce and safeguarding assets, demonstrating the timeless utility of banking services. Medieval banking. During the Middle Ages, banking became more formalized, especially in Europe. The Italian cities of Florence and Venice were hubs of economic activity, and families like the Medicis were pioneers of banking. They introduced practices such as bills of exchange, allowing merchants to trade without carrying large amounts of gold or silver. The spread of banking facilitated more trade routes such as the Silk Road connecting Europe and Asia. These advancements highlight how banking not only supported local economies but also enabled global trade long before the modern era. Modern banking. The Industrial Revolution marked a significant turning point. The explosion of manufacturing and commerce required centralized financial services to support growth. Modern banking emerged with institutions offering structured services like savings account, fixed deposits, and credit facilities. Technological advancements have also redefined banking. From the introduction of telegraphs and computers to today's digital apps, modern banking has grown to provide faster, safer, and more accessible services. For instance, mobile banking allows people in remote areas to participate in the global economy, reflecting the democratization of financial services. Classification of banks. Banking institutions cater to various economic needs and are classified accordingly. Commercial banks. They cater to individuals and businesses offering accounts, loans, and payment services. For example, HDFC and ICICI in India provide comprehensive banking services to retail customers. Investment banks to specialize in high level of financial operations like mergers, acquisitions, and underwriting. Morgan Stanley and Goldman Sachs are global leaders in this field. Central bank. Every nation has a central bank, such as the Reserve Bank of India or the Federal Reserve, which regulates monetary policy and ensures financial stability. Cooperative banks. These community focused banks aim to meet the specific needs of smaller groups such as farmers or small business owners. Banking system. Unit, branch, universal, and banking markets. The structure of banking system varies. Unit banking. These operate without branches, focusing on localized service. While less common today, they are significant in regions where community banking is vital. Branch banking. This model is predominant worldwide with banks like State Bank of India operating vast networks. It enables access to financial services even in rural areas. Universal banking. Combining multiple services under one roof, universal banking is a one-stop solution. Examples include Deutsche Bank and JP Morgan Chase. Banking markets. Whether retail, corporate, or international banking, each segment addresses unique financial requirements. Retail banking focuses on individuals, while corporate banking supports large organizations. Functions of modern commercial banks. Modern commercial banks perform a wide range of functions essential to economic activity. Deposit taking. By accepting customer deposits, banks provide a safe place to store money. In return, they offer interest promoting savings. Lending. Banks lend these deposits to individuals and businesses, fueling investments and consumer spending. A loan for a startup can transform an idea into a business. Payment processing. With technologies like UPI in India, banks facilitate swift, secure, and reliable payments. Financial advisory services. Banks guide customers in wealth creation, retirement planning, and investment decisions, enhancing financial well being. Balance sheet of commercial banks. A commercial bank's balance sheet is a financial statement that offers a snapshot of its financial health at a specific point in time. It consists of three main sections: assets, liabilities, and equity. Let's dive deeper into each component to understand their roles and significance. Assets. Assets represent what the banks own or control to generate income. They are vital for sustaining the bank's operations and profitability. Here are the key categories: loans and advances. These are the largest component of a bank's commercial bank's assets. When banks lend money to individuals, businesses, or government, it becomes an earning asset as it generates interest. For example, housing loans, business loans, and personal loans fall under this category. Loans are classified as performing or non-performing assets, that is NPAs, with NPAs requiring special attention due to the risk of default. Investments. Banks invest in government securities, corporate bonds, and other instruments to earn returns while maintaining liquidity. Government securities, also known as gilt-edged securities, are considered low risk and highly liquid investments. Cash and cash equivalents are the next item. This includes the cash held in banks' vaults, ATMs, and deposits with other banks or the central bank. Cash reserves ensure that the bank can meet its customers' withdrawal demands and statutory reserve requirements. Other assets which are maintained by banks, which are includes fixed assets like buildings and equipment, receivables, and intangible assets like patents or goodwill. While not directly income generating, these assets support the bank's infrastructure and operations. The next part of the balance sheet are the liabilities. Liabilities represent what the bank owes to its stakeholders, including depositors and lenders. These are the funds that the bank must repay in future. Let's break them down and see them one by one. The first one are deposits. Deposits form the largest liability for commercial banks. They include savings accounts, current accounts, and fixed deposits. Depositors entrust their money to the bank in exchange for safety, accessibility, and interest on certain deposits. Fixed deposits, for example, have higher interest rate but lock in funds for a specific period, while current accounts provide liquidity with interest. The next item is borrowings. Banks often borrow from other financial institutions or the central bank to meet short-term liquid needs or finance large projects. Borrowings can include interbank loans, loans from international financial institutions, and funds from money market. Central bank may provide these funds through instruments like repo agreements where banks pledge securities in exchange for cash. The other liabilities may include accrued expenses, which are those expenses which are payable, tax owed, the payments due to vendors or service providers. Contingent liabilities come next. Contingent liabilities like guarantees and letters of credit issued by the bank also fall in this category, as they can become actual liabilities under certain conditions. The last part or the third part of the balance sheet is equity. Equity represents the bank's ownership funds contributed by shareholders or the retained from profits. It is the cushion that protects the bank's creditors and depositors in case of financial difficulties. Share capital. This is the money raised by issuing shares to investors. It represents the core funding of the bank. Equity shares indicate ownership, while preference shares may offer fixed returns without voting rights. Next item in equities are reserves and surplus. These are profits retained by the bank instead of being distributed as dividends. They serve as buffer against unexpected losses and help the bank expand operations. Examples include general reserves, capital reserves, and statutory reserves mandated by regulators. Next item are retained earnings. This is the cumulative profit kept by the bank after paying dividends to shareholders. It reflects the bank's capacity to reinvestment and long-term growth. Credit creation by commercial banks. Credit creation is one of the most critical and impactful functions of commercial banks. It refers to the process through which banks create new money in the form of credit, thereby expanding the money supply in the economy. Let's explore this concept in detail. Credit creation occurs when banks accept deposits from customers, use a portion of these deposits to extend loans to others. While this may seem straightforward, the process has far-reaching implications for the economy as it increases the overall money supply. Here's the core idea. When banks lend money, the borrower spends it and the recipient deposits it back into a bank. This deposit can then be used to create more loans, repeating the cycle. This multiplier effect is the essence of credit creation. So let's see how credit creation works. Now let's break the process into steps for better clarity. Now the initial deposit. A customer deposits money into a bank. For example, let's suppose a customer deposits rupees 10,000. This amount becomes a part of the bank's reserves. Okay, and reserve requirement. Banks are required to keep a portion of deposits as reserve, either as cash in their vaults or as deposits with the central bank, which means the whole amount cannot be given as a loan. This is called the cash reserve ratio or reserve requirement. Now let us assume the reserve requirement is 10%. In this case, the bank will keep 10,000 rupees, which is 10% of 10,000 rupees as a reserve, and will have 9,000 rupees available for lending. This bank lends that 9,000 to a borrower. The borrower uses this money, for example, to purchase goods or services. Now, the recipient, the person to whom that 9,000 rupees goes, or the recipient of the 9,000 rupees spends it, and the seller again deposits the same amount in their bank account, whether it may be the same bank or some other bank. Now the process of new credit becomes active. This 9,000, which is a deposit, becomes a fresh deposit to another bank, which again keeps 10%, that is 9,000 rupees as reserves, and lends the remaining 8,100 to a new buyer. This cycle continues. This process multiplies the initial deposit into a much larger amount and the total deposits and loans across the banking system. So let us see a real world example of this credit creation. To make this tangible, let us see an example. Okay, a company deposits 1 lakh rupees in a bank, in a bank A. Bank A keeps 10,000 rupees as reserve, which is 10% being the reserve ratio, and lends the remaining 90,000 to a borrower. The borrower purchases machinery and the seller deposits that 90,000 into bank B. Bank B keeps 9,000 being 10% of the reserve and lends 8,100 to another borrower. This cycle repeats, and with the initial 1 lakh deposit in total credit across the banking system. So let us now see how important is banking to the economy. Banking institutions are the lifeblood of the economy. They provide financial stability by managing risks like defaults and ensuring trust. Banks safeguard the economy. For instance, during the crisis like 2008 recession, Central banks stepped into stabilized financial statements. Economic growth. By funding infrastructure projects, banks directly contribute to job creation and development. Social development. Programs like microfinance have empowered rural communities and women entrepreneurs, showing how banking can drive inclusive growth. So we have come to the end of Unit 1, wherein we saw the origin of banks, then we saw the different types of banks, banking system, then we saw how credit is created, and why are banks important for the economy. So from this, let's move on to see about the Indian banking system in Unit 2.